Awesome. Hello, everyone, and welcome to today's session on navigating your financial future, key considerations for starting practice. My name is Carissa Walker, and I'll be your moderator for today. I am an early career education specialist with MD Financial Management, and my role is to provide financial literacy for medical students, residents, and new in practice physicians. I'm so glad that you could join us today. We know how busy you are, and we're excited to help make your transition to practice a little bit smoother or address top concerns for those of you that may be in practice. Now, this session is brought to you by MD Financial Management and Scotiabank, and we're here to support you from medical school all the way through to retirement. So Scotiabank's Healthcare Plus Physician Banking Program was designed to provide a robust suite of tailored banking services, while MD Financial Management focuses on delivering financial planning services designed for physicians and your families. So together we can provide comprehensive financial planning, advice, and solutions specific to physicians and your needs. Now, our goal today is to bring together professionals from MD Financial Management, Scotiabank, MMP, along with a practicing family medicine physician to share essential financial insights tailored for you, whether you're in residency or beginning practice as a family medicine physician. Now, before I introduce our panelists here, I wanted to see who we have online on the call today. So if you could put in the chat box, maybe what year of residency you're in or a year of practice and where you're located, that'd be great. I'll give it a minute here. Okay. Oh, resident 2 in Montreal just finished residency. Congratulations. 7th year of practice, Nova Scotia. Awesome. R2 Alberta. Hi, 1st year of practice, Whitby, Ontario. Oh, awesome. Wow, we have people joining us from all over Canada. That's great. Okay, so we'll jump into kind of introducing our panelists here. You can keep filling out where you're joining us from. It's great to see you all on the call. So we'll start out with Dr. Kish Lister, who is our physician joining us today. But Dr. Lister, I'll pass it over to you to introduce yourself to the group.
Perfect. Thanks, Carissa. My name is Kish. I practice in Regina, Saskatchewan. I'm the director of a high acuity care unit in Regina here, and I do critical care transport medicine. I work through the lens of a family physician. As you can see, I was trained in family medicine and emergency medicine here in Saskatchewan, and it's a huge honor for me to be here as kind of a mid-career physician to maybe answer some questions along the way. Thanks, Carissa.
Awesome. Thanks, Kish. Melissa, I'll pass it over to you to introduce yourself.
Thanks, Carissa. Hi, everyone. My name is Melissa Allen. I'm a senior financial consultant with MD, and I'm located here in Kingston, Ontario. I've been with MD for 7 years. I will age myself. I've been in the industry for over 20 years. And I love being at MD, helping physicians basically identify and make a plan for their goals. I specifically work with students, residents, and new to practice physicians as they have a lot of financial planning that needs to be done. And that is essentially how I'm able to support you. Thank you.
Wonderful. Thanks, Melissa. Sherveen, I'll ask you to introduce yourself.
Thank you, Carissa. My name is Sherveen Cameron, and I have the privilege of leading a dedicated team of healthcare specialists across the Ontario region. I have been in the banking and financing industry for 20 years, and I've had the opportunity to work in different cities, including Montreal, Quebec City, and Ottawa, where I am currently based. Throughout my career, I have worked in different positions from personal banking, business banking, and management. And with my expertise, I have been focusing on providing tailored financial solutions to all my clients, supporting my team and communities with their financing and financial needs. Very happy to be here, and I'm looking forward to an engaging conversation.
Wonderful. Thank you. And last but not least, Nick, I'll hand it over to you.
Hi there, everyone. Great to meet you all. My name's Nick. I'm here with MNP, which is a national accounting, tax, and consulting firm. I lead our healthcare advisory team, where we work primarily with healthcare professionals and physicians to help them set up their careers and their financial goals. So we work closely with our partners at Scotiabank and MD to help you answer questions about, should I incorporate? How should I pay myself? All these fun questions that we have early on, but then we take it a step further and we actually come in and can support you across your entire career life cycle, including HR consulting, digital and systems, and making sure that everything is in place to make sure your practice is successful.
Awesome. Thank you. So now that we've gotten to know a little bit more about each of our panelists, I wanted to go over what the format for today's session will look like. So we have designed the session to be an open forum panel discussion covering 4 key topics. Each will spend about 10 minutes of time discussing. So if you have any questions throughout the session, please feel free to enter them into the chat, and we'll do our best to answer them during the discussion. If we happen to run out of time, then we do encourage you to connect with us after to talk about any of these questions or anything beyond in more detail. I also wanted to take a minute to introduce Alina, who is on the call today as well. So if you have any questions in French, then she is here and will translate them fully for us there. Okay, so that will move us into our first talking point here. So to really set the stage with our discussion, I wanted to talk with Dr. Lister about his experience transitioning into practice. So first question I have for you, Kish, is looking back, what is one thing that you wish you maybe could have told yourself in hindsight about the transition to practice?
That's a great question, Carissa. I think, honestly, I would tell myself in hindsight that everything's going to be okay. Transitioning into practice is a time when it can be met with a lot of stress. There's a lot of unknowns. There's a lot of decisions that need to be made. But I think the important thing is take one step at a time. This is going to be a marathon, not a sprint. Sometimes I think it's actually probably more correct to say it's a marathon made out of mini sprints, but you don't have to know everything when you start. You don't have to do everything quickly. You don't have to do everything that gets asked of you, as there seems to be overwhelming when you first get out of residency. It's okay to ask for help clinically and financially. And I think as you start, the more comfortable you are asking for help and asking for direction from mentors, the better off you're going to be.
Awesome. Thank you. And looking back as well, is there one thing that you maybe thought would be the hardest part of transitioning into practice? Did that turn out to be true, or did you maybe not think of something that ended up coming up when you transitioned?
Absolutely. So yeah, when you first go into practice, the thing that used to keep me awake at night for the first few months when I went into practice was this whole idea that I would be making these clinical decisions without the safety net of a preceptor to run things by. And that is something that you feel. It takes a long time for that to go away. But interesting, I'm not certain that was the thing that's the hardest part of transitioning into practice. Like I said before, you do have mentors. There are people you can ask questions of. And I think probably the more difficult part of transitioning is the non-clinical part.
Awesome. And not to put you on the spot here, but thinking about your financial knowledge, how has that evolved from when you were in residency to now?
It's definitely evolved a lot. So I absolutely was interested in finance as I was going through university and through medical school and residency. But as you go into clinical practice, you actually end up managing a lot of things financially that you didn't really think were going to be a big part of your life. As a resident, you're getting paid a salary, and you go in, you do your time, and you go home and your salary comes home. You don't have to manage a team. You don't have to manage employees. You don't have to manage commercial leases. So I think for me, really the hard part was starting to understand, how do I build that team of people around me? What are the things that I can add value to, and what are the things that people will be able to add value for me? Because clearly there are experts that do this for a living, and we as physicians can concentrate on the physician part while we have our team members work around us to help reach the goals that we have. And what is our goal for lifestyle? What is our goal for saving? How do we see our career working out? And I think that's where it's important, just to build that team and be able to ask them for help.
Awesome. Thank you. That sets us up perfectly for our discussion here today. And Dr. Lister will be here as well, of course, throughout the whole session to add in insights. So we'll move on to our managing debt and financing a clinic topic. So of course, many residents and new in practice physicians wonder what happens to their line of credit once they start working. So Sherveen, I was wondering if you can kind of walk us through these key changes and things that they should be looking out for.
Absolutely. And this is a big question when you finish your study and you're wondering what's going to happen now to my student line of credit. Of course, depending on where your banking is, you want to reach out to your advisor and find out what are the terms and conditions of your student line of credit and what are your options. At Scotiabank, you have different options when you finish residency. You can keep your student line of credit and turn it into a personal line of credit if you wish, so you can continue to use it, pay it down the balance that you have, and use the limit that you have because it's a revolving credit. You can also transfer it into a personal, professional line of credit after, of course, speaking with your accountant and making sure that there is no negative tax implication for yourself, or term it out and pay it out completely and close it if you are not planning on using it, or if you're not interested in having access to it going forward. At a Scotiabank, you also have the option of having a combination of these three solutions and options. So it's important to talk to your advisor and find out what are exactly your options based on where you are at with your career, how long you have been practicing, when did you finish your residency. The timing is important, but definitely there are options, and each individual is unique. So having the conversation to find out what is available to you, it's key.
Awesome. Thank you. Next question on the debt management side. So what should physicians consider when taking on new debt, specifically in regards to practice expenses or setting up a clinic?
I want to mention first that not all debt is bad debt. When you're getting financing for your practice, keep in mind that's a good debt because it's going to help you to grow your practice, generate more revenues, build your retirement planning, and achieve your financial goals. But mainly when you're looking to get financing for your practice, these are the key points that you want to pay attention to. What type of loan you're looking to get? What are the term and condition of that loan? Are you looking at a variable contract? Are you looking at a fixed contract? What are the amortization period available to you? What type of interest rate is available to you and it's possible to obtain? What is the objective of that loan, and when are you planning to pay it back? These questions are the questions that you want to talk to your healthcare specialist and your accountant to make sure that we build the right solution and the most cost-effective solution for yourself.
Awesome. And I do see we got a question in the chat here. So I am trying to set up a new clinic after semi-retiring for a few years. What resources are there that can help with physical building of the facilities and teams of managements to reach out?
And that's, you definitely want to make sure that you have a good accountant, a lawyer with you, because you're going to have a lot of tax question, a lot of legal question that you have to address, and you want to get the professional opinion and advice on those questions, and your healthcare specialist from the beginning, so we can really guide you what you have to put together, what type of package you need to get your financing process started, because it's not complicated, but there's a lot of information that we need, and there is a process that we have to go through. Real estate agent, are you working with the right real estate agent to help you find the right location for yourself? So making sure that first you're talking to your healthcare specialist and ensuring that you have your professional team around you, that they can advise you on all the aspect of your financing and your project is the key. I would start by reaching out to your healthcare specialist. If you don't have a healthcare specialist, but you have an accountant that you're working with, reach out to your accountant and they will be able to tell you what's the next step based on what is your project. What are you planning to do?
Awesome. Thank you. Okay, so the next question I'll throw over to Melissa and Shervin as well. If you have anything to add to it, that would be great. So Melissa, it's of course very common for medical students to graduate with high amounts of student debt, carrying that over into residency, possibly accumulating more. So when they look at when they are in practice, the consideration of starting to pay down their debt versus carrying it longer and starting to invest. Can you kind of talk us through what are the trade-offs and considerations that should go into this question?
Thanks, Carissa. So when I meet with clients on a regular basis, a lot of them are really motivated to pay off their debt after carrying it for many years. So usually I just sit with them and have a discussion around what their personal circumstances and goals are, and really identify where they are today and where they want to be. We really approach things from a holistic planning point of view. It generally doesn't make sense to just strictly pay down debt at the beginning of practice, because depending on the tax rate that they're in, it will make a lot more sense to maybe fund some registered investment opportunities like an RSP or a first-time home savings account, depending on their goals. So generally speaking, we'll just have a good discussion, and I will explain to them the tax savings if they were to start any of these investment vehicles like those accounts, and really map out a plan how to pay down the debt. I often tell the individuals that I work with that debt is like weight, easy to put on and hard to get off, and I get it. I'm going to work with them to have a good plan to pay down the debt, but it's also important that we look at the broader picture and we really minimize the tax burden and things like that as well.
Awesome. Dr. Lister, is there anything that you would like to add to that in terms of your personal experience?
Thanks, Carissa. Yeah, I think Melissa made an incredibly good point, and so did Shervin. When you're approaching it, debt sort of has a visceral or an emotional tone to it, depending on kind of your experiences as you were growing up, going through university. And so there's certainly an emotional component of what is the level of debt you're willing to carry. And Shervin very clearly pointed out there is a difference between good kinds of debt and bad kinds of debt. There are debt that is deductible from a tax perspective, and there's debt that's not deductible. And I really think it's so important to meet with your financial planner and your accounting team to try to figure out how can you structure your debt repayment or debt usage in the most efficient way possible. Everybody's situation is going to be a little bit different, but structuring the way you have your debt and your debt repayment can make enormous differences in the amount of after-tax income you are able to either have or retain. So yeah, that's what I would add.
Awesome. Okay, and Shervin, last question for you that I have is for those considering partnering in a clinic, what do they need to know about financing and acquisitions?
I feel like I'm repeating this, but I can't stress enough how important this piece is to, again, make sure that you have your professional team. From the beginning, you work with your professional team. If you're partnering or you're planning to partner up with someone, you definitely want to consider a good partnership and shareholder agreement, which you want to work with your lawyer and your accountant to make sure that your interest is covered and it is a safe partnership that you are getting into. Obviously, you also want to make sure that you are getting into a partnership with someone that you trust, because a partnership is just like a marriage. So you want to make sure that you know who you are getting into business with, and what are the implications to work with this person. You want to make sure that you're keeping in mind the collateral and security requirement in support of your financing request, because in some cases we need to have more security and collateral from shareholders. So what does that mean? What does that mean to you and to your business partner when it comes to do the credit application? These are all the sensitive conversations that we need to have with each partner, and you want to make sure that you are on the same page with your partner when it comes to these type of requirements for financing. The responsibility of the repayment of the debt, you want to make sure that it is clear, and working with your healthcare specialist, with your banker and your accountant and lawyer, making sure everybody's on the same page when it comes to the structure of your partnership, when it comes to the financing requests of your project, that it's clear and everyone is on the same page, are the key point when it comes to financing requests.
Awesome. Thank you. So we've already seen today a lot of common themes of really going back to building that professional team around you. That's why today we are really lucky to have multiple members of the professional team online to help answer any of your questions. But that brings us into our next topic of focus here. So we'll spend the next 10 minutes or so really talking about investing and life planning. So Melissa, let's talk about the bigger picture when it comes to saving and investing. Starting more broadly, how should new in practice physicians or those in residency think about investing? I know that that's a pretty broad question, but maybe kind of talking through where did they begin and how they really make sure that their strategy supports both their long and short-term goals.
Thanks, Carissa. So yeah, I guess when it comes to saving and investing, usually we really want to prioritize and basically identify what the account is going to be used for. If it's a short-term goal, they probably do not want to be taking a lot of risk with their investment. But if it's a long-term goal, then you probably want to start establishing a long-term investment. So generally speaking, you want to look and identify what your risk tolerance is. And, you know, it's interesting because a lot of the newer or younger physicians haven't really encountered a market downturn per se. So if you're making your very first investment, you know, on paper, a lot of people think that they have a medium risk tolerance, but in theory, they become very uncomfortable during times of volatility. So we really encourage physicians to just start a small saving strategy. You have to start somewhere. And basically, you can figure a lot out about your risk tolerance and how that feels with little amounts of money to start. We also want to basically look at the tax efficiency of the investments that they choose, whether it's through a corporation or if it's through a registered account like an RSP, a first-time home savings account, or a tax-free savings account. Generally speaking, our advice on which account to have will be based on their career stage and what their goals are. So the registered investment vehicles like the first time home savings account or the home buyer plan RSP program can work very well for new to practice physicians. It's generally like having their cake and eating it too. They can save for a home and also significantly reduce their income tax burden during the first couple of years of practice. So, generally speaking, we would recommend that you just have a meeting with a financial consultant, whether it's MD or your own consultant, and really just have a discussion around what your goals are and making a plan for them.
Awesome. And I want to throw it over to the group here as well. So if you have any questions about how an RSP, FHSA, TFSA, any of those work, please feel free to drop them in the chat. But while we're on this discussion, Melissa, when people are looking at getting into investing and what ways they can invest, whether that's through a robo-advising platform or through direct trade or working with a financial advisor, can you kind of talk through some of the considerations when they're deciding how they want to invest and what platform they're doing so through?
Sure. So really it depends on their investment knowledge and what their comfort level is and how much time they want to spend on managing their own finances. I'm a firm believer that everybody needs a financial planner. If you are using your own resources and doing a direct trade platform, then the fees might be smaller on those type of platforms, but they're generally not getting any advice. And financial planning is very important. And when you work with a planner, they can really help keep you on track to meet your short and long-term goals. I think it's also very important that you work with a firm or an advisor that's transparent about their fees. There's a lot of individuals and banks and firms out there that want to basically, have your business. And it's important that you understand how your advisor is compensated, whether it be through commission or bonus or salary and things like that. So many firms, including MD, have a low fee, like robo-advisor offer, which essentially there are pros and cons to that. I know at MD, then we essentially can still give you financial planning in our low fee offer. And it's, very important that you understand that. In some of our platforms, we actually work with portfolio managers. But I guess the key takeaway there, Carissa, for me, for everybody is basically just to make sure that you understand how your advisor is compensated and that they're transparent about it.
Definitely. Thanks, Melissa. Another point that I'd like to add to that is when you're looking at the different ways to invest, it's definitely not a one size fits all. And it's really looking at the interest that you have in investing and the amount of effort and time that you want to put into it. Some people are really interested in it and want to be more involved, and there's ways to do so. So really kind of assessing as well yourself when it comes to what type of investor you are. A question that we have, Melissa, in the chat here is, do you have any suggestions on what to buy in the FHSA if you're planning to buy a home in 2 to 3 years?
Thank you. Great question, John. So generally speaking, I encourage you to ask yourself, is the risk worth the reward? Short-term goals, 3 years or less, I would guide you to probably be a little bit more cautious. If you have a plan to buy a home in 2 years and you have to delay buying a home because you went into an ETF that maybe went down 20% or whatnot because of, all of the volatility that's happening in the markets, then you don't want to delay buying a home for a year or being forced to cash out that first-time home savings account at a loss. So generally speaking, I would probably encourage you to do a cashable GIC or a high-interest savings account or things like that. 3 to 4 years, it may make sense to invest, but you really want to look at your individual circumstances and be aware of that risk versus reward opportunity.
Awesome.
If I can jump in on that one for a second. So yeah, Melissa, I think you're bang on. And the way I often think about it is that, from a risk reward perspective, there's actually two elements you're thinking about. One is return and other is time, right? Which is you might be willing to take on that additional risk to get a higher return, but then you need to be flexible in that time. So if you're in a market downturn, maybe you're not buying for 5 or 6 years, so you give markets time to recover. So you can take that risk, but recognize that there's a consequence in either of those metrics.
Awesome. So the next question we have here is, we've heard from some physicians who are starting a family and wondering, how do I plan financially for starting a family while still paying off debt and building my practice?
Great question, Carissa. One that I get asked all of the time by my resident physicians is, Melissa, can I afford to have a kid? When should I start a family? And I always joke with them, as a mom of two, that we can make a plan for you and you can afford it. My best advice is essentially to get a handle on their discretionary spending and to set realistic goals. Taking 18 months off for a parental leave may not necessarily be realistic. You can look to share parental leave with a partner or spouse. There are a lot of things that you can do to better prepare yourself in advance to family planning. And again, every situation is different. So some physicians are lucky enough not to have debt, and I would encourage them to essentially put money away in a savings account to prepare for that reduced income. However, if they had a lot of line of credit debt and they had a healthy amount of credit available to them, I would encourage them to essentially take the additional cash flow, pay down the line of credit to save on that interest. And, it's okay to take a little bit of a step backwards financially when it comes to kids. It's kind of the start of that. We all know that children are very rewarding, but they cost a lot of money. And it's kind of just preparing you for the future and all of those things. It's well worth it. My best advice is just to essentially try to get yourself in the best financial situation as possible. And kids only really need their parents' love. And I know that sounds like really ridiculous, but if you're trying to keep up with, colleagues or other people and buying a $3,000 or $4,000 stroller that you see online with the social influencers and all of those things, it's probably not necessary. So I usually just try to have a general discussion with them about setting realistic goals on what they can afford. Some physicians, if they're incorporated, they will continue to draw a salary during parental leave from their corporation, which can be very useful. And I would also encourage everyone on the call, if they are considering family planning, to reach out to their local province and find out what benefits are available for self-employed physicians. A lot of people will try to have babies during residency because their province typically will pay them a salary, a reduced salary, but they will get them some good benefits, and it's less stress at that particular point. However, if they're self-employed, they don't get any income outside of their provincial benefits. So I know recently in Ontario, they made a change that they've increased the payment up to $2,000 a week for self-employed practicing physicians for 22 weeks, which is very good. So that's essentially what I would recommend when it comes to that.
Awesome. And last question I have for you, Melissa, in this section today anyways, what types of insurance are essential when starting practice? So when thinking about life insurance, disability, liability, and when should physicians be thinking about getting them?
Another great question, Carissa. So in my opinion, disability insurance is imperative, especially as a self-employed physician. If you don't work, you do not get paid. So that would probably be my number one recommendation, whether or not it be professional disability as well as potentially some overhead coverage for your clinic. It's very, very important. Some physicians will take out a private disability insurance policy during residency, essentially just to guarantee their insurability for down the road. And they do have a basic policy with their province during residency, but it's imperative that they have a good policy for practice with their own occupation definition of disability. My next recommendation would be to ensure that they have a really good health insurance coverage, because all residents receive some health and dental coverage through their employer, which would be the province that they're working in. However, when that residency ends, they also lose those benefits. So if you have a spouse or a partner and you're able to go on their policy, I would highly recommend that. It's probably more cost effective for them to go on a partner's policy versus buying a private health insurance plan. A lot of people will feel like it's very expensive to have a private policy, and it is, unfortunately. However, you want to make sure that you have something with unlimited prescription drugs in the event you have, a big diagnosis and you need a very expensive medication. So I would definitely prioritize those two things. Other considerations would be some term life insurance, maybe to replace income or to cover your debts, and maybe even a private critical illness insurance policy in the event you were to get diagnosed with an illness. But I would prioritize that as number 3 and 4, to be quite honest with you. And I do think that disability insurance would be something that I essentially say is non-negotiable. You should look at the premium options that are available to you. So if cash flow is still negative every month and you feel like, I know I need it, but I can't afford it, something is better than nothing. And again, we can basically walk you through some optional riders and some solutions that you should be considering. I'm an insurance advisor. I'm qualified on insurance products, but at MD, we don't specifically sell those products. So we're very unbiased when we basically do the comparison, which is a good thing. I have nothing to gain from my clients, whether they take it with their PTMA or a private third-party firm. But I love talking with them about the options and making sure that they're set up for success there.
Wonderful. Thank you. And Kish, is there anything that you would like to add about it in terms of insurance? Is there a way that you think about insurance with, types that you consider maybe more important for yourself to have?
Yeah, no, I echo everything Melissa said. Insurance is a funny topic because none of us really want to think about insurance, especially as you get out into practice and you start thinking, am I really going to spend $1,000 a month on private health insurance or on disability insurance? But I would agree. Number one, disability insurance is absolutely non-negotiable. You're a private contractor or an independent business, and without disability insurance, you could get into huge financial trouble very quickly, even from a simple illness. So I agree, disability insurance is very important. And then I also agree, some form of life insurance, be it term or whole life insurance, to ensure that you can cover debts if you were to have a sudden and unfortunate departure. And then Nick can probably fill in later, but there are also corporate benefits to owning different types of insurance policies. That's a little bit more of a nuanced topic, but as you start to have excess cash flow, actually using insurance can be a good form of self-finance and tax deferral. So I'd encourage you to talk to your advisor about that as you kind of, not in your maybe first couple of years of practice, but as you go a few years further in. And then the last thing I'll say on that, again, insurance isn't fun. No one wants to talk about it. No offense to people who provide insurance, but it's very important. The earlier you get qualified for your insurance, the cheaper and easier it's going to be to afford. So if you wait till you're 85 years old to start looking at life insurance, it's not necessarily too late, but probably pretty close. So get it when you're young and when you're healthy, and your fees will be much less.
Awesome. Thank you. So I'll open it up to the attendees here. If you have any questions on investing before we move into incorporation and tax planning. I'll give it about a minute here.
Maybe while we're waiting for the attendees, I'll just say, especially for people who are starting in practice, you live in a remarkable time in terms of investing. The amount of information that's available and the programs that are available, as well as how inexpensive it is compared to how expensive it used to be. It's a huge advantage. It's a great time to be able to invest. So take some interest personally in it. It's a really great time to be able to invest.
That's a great point. And throughout the session too, I'll try to grab the link for it. But on our website, there's a lot of great resources out there for you. But if you are wanting to look into more information on any of the topics that we're talking about today, we do have a spot on our website called InvestedMD. And there's lots of articles, everything from investing, debt management, incorporation. So if you have want to do some research on your own, then that's a great place to start. Okay, so we'll shift into incorporation and tax planning. So these are definitely some hot topics for new physicians. Now, Nick, what should someone be thinking about when deciding when to incorporate? And what are some of the pros and cons when it comes to incorporating?
Yeah, sure. So, I mean, it's a lot more of a complex question than it used to be. There are a number of tax changes that came into place over the last 10 years that have made it less of an obvious answer. So it used to be that basically as soon as you started practice, you would incorporate. Now we have to think about it a little bit more carefully. So roughly speaking, the benefit of incorporating is the ability to defer tax into the future. And you can only do that to the extent that you're leaving money behind in the corporation to be invested to pay down debt for other purposes. So our main kind of threshold that we want to look at is, do you have excess discretionary cash available for saving? If the answer is yes, then maybe incorporation makes sense. If you need all of the cash that you're generating right now to support your lifestyle, pay for your mortgage, pay down student debt, then it's probably going to be a couple of years down the road before we have that incorporation discussion.
Awesome. And there's a big discussion around paying yourself via salary or dividends. Can you explain the difference around paying yourself out in these different ways?
Yeah, absolutely. So I guess maybe first and foremost, let me take a step back and talk a little bit about how taxes with a corporation work, and then we can get into some of the nuance there. So the default is you're an unincorporated person earning your income in an individual capacity. In that case, you're subject to your personal tax rates, similar to what you would pay now if you're earning a salary as a resident. Obviously different rates across the country, but the highest marginal rate on average is approximately 50%, depending on what province you're in, at the personal level. If you incorporate, what you're doing is you're basically interposing another layer into kind of the tax picture. So instead of you receiving money personally, your corporation is going to receive that money and it's going to pay a certain level of tax. So in Ontario, for example, the small business tax rate, you pay 12.2% as opposed to the 50% you might pay personally. But it's not as simple as just incorporating and cutting your taxes from 50% to 12%. What that means is that now that money's in the corporation, you've got to be able to get it out to you personally. And when you take it out personally, you're going to pay another layer of tax. And coincidentally, when you combine the rate of tax that you pay in the corporation and the rate of tax that you pay personally, taking that money out of the corporation, it's going to be about 50% total. So really, it's this concept that is consistent throughout Canadian tax legislation called integration. And what it says is it doesn't matter at the end of the day if you earn your money personally, corporately, through a partnership. By the time that money is in your personal pockets and you can spend it for personal use, you're going to pay about the same rate of tax. So it kind of leads to an interesting dilemma with that question about salaries or dividends. Doesn't matter, and that would lead you to believe that maybe it doesn't. But there are certain factors to think about as you kind of walk through that analysis. So if you take that money into the corporation and the corporation pays tax, well, what's left for that after-tax income called retained earnings, you can take that out as dividends, which are taxed at a lower rate than salary. Dividends can be helpful because they're very flexible. There's no required tax withholdings. You don't have to, submit your payroll tax to CRA on a regular basis. You really just pay your taxes once a year at the end of the year or through installments based on your dividends. Dividends are not subject to CPP, so you don't have to pay that additional amount into the CPP every year. So it might look on the surface like you're actually paying a lower tax rate. Salaries, on the other hand, might be a higher tax rate, but you are participating in the CPP. So while it might feel like a tax, it is a pension plan. It is an investment towards your future and your retirement. Salaries also generate RRSP contribution room. So if you're not taking a salary, you don't generate any room in your RRSP, and you can't take advantage of that tax deferred vehicle that's available to you. So a couple kind of factors on each side. It's going to be different for everybody. What I would say is, meet with your tax advisor, meet with your financial advisor from MD, and you can work through the scenarios of what your needs are in terms of what excess cash you have available to invest, how much you need for your lifestyle, whether or not an RRSP makes sense for you, and then you can come up with the right kind of overall picture for yourself of what tools you should be using and how to get the most efficient result.
Awesome. Thank you for that overview. Any questions in the chat there on incorporation as a whole, maybe more broad level too, as we kind of get into more specifics? As we wait too, just wanted to pause there to see if Kish or Melissa, Sherveen, if there's anything that you'd like to add when thinking about incorporating on a higher level that Nick hasn't already mentioned.
One thing I'll just add is that Nick, I'll echo what he said. It's just a matter of one thing that I encounter a lot, I will back up, is that physicians feel they need to incorporate right away. And that's not necessarily the case, because if you have a lot of RSP room, or if you are paying down your personal debt and you don't have anything left to keep in the corporation, it really doesn't make sense. So we work very well with MNP, and I would just say you want to make sure that you're working with a planner and an accountant that has your best interest at heart, and don't feel you need to do that right from day one. Essentially, every person's situation is different.
Thanks, Melissa. Okay, Nick, another question for you. So when incorporated, what are the options around income splitting with a spouse and or children, if that's possible, and when?
Yeah, so this is something that's really drastically changed over the last couple of years. So how it used to work was when you set up your professional corporation, you could have your family members as shareholders. So your spouse, your kids, your parents. Depending on which jurisdiction you were in, you might be able to have a trust or not. But what we were able to do at that point in time, say you had adult children, you could pay them a dividend of up to $35,000 to $50,000 a year, tax-free, if they had no other source of income. So this income splitting was really pervasive, where we always put family members in the corporation. We always paid them a dividend so that we could access their lower marginal tax rates. The rules that changed back in 2017 put a stop to that in a lot of ways, where basically now the default position is if you're paying dividends to a family member that's not actually working in your business, then those dividends are automatically subject to the top rate of income. So that's called the tax on split income. And so in a lot of ways, that put an end to the practice of income splitting. But I guess I'll put a caveat there that you never say never. There are some situations where it makes sense. So, one that I talked about or I alluded to earlier is if you have a family member that's actually working in the business, you do have the ability to pay them dividends or salaries for the work that they do at fair value. The other piece is that for retirement planning, once you, as the practicing physician, turn 65, your spouse is allowed to receive dividends out of your corporation. So similar to how you can split pension income, if you're a government employee earning a pension, you have the ability to split income in retirement. So even though it might not make sense to pay your spouse any income today out of your corporation, it can still make a lot of sense to have them in there as a shareholder, so that you're setting yourself up for that future long-term planning to take advantage of your lower tax rates in retirement.
Awesome. Taking a step back from incorporation and focusing a little bit more on the tax side of things. So one piece that we like to outline for residents preparing for their transition to practice is really how their taxes will shift once they are new in practice. So can you kind of talk through how tax installments work and maybe some tips around preparing for that in their first few years of practice?
Yeah, sure thing. So I guess to start off, your default state right now is a salaried employee, which is the easiest it's going to get for you, because you get a T4 slip, tells you, we've already withheld this much tax, put this in a tax return, fill out the form, and you're basically done. Once you transition into practice and you're no longer a T4 employee, you're a self-employed contractor, whether incorporated or not, you shift from just filing that one form to having to prepare a statement of income. So you have to report all of your professional revenue, look at all the expenses that go into that revenue. So you need to track all those items, keep your receipts. And at the end of the year, when you prepare your tax return, or you have your accountant help you prepare your tax return, they're going to enter that statement of business income form, ask you some questions, and help you determine what's deductible, what's not deductible, and get to your ultimate net income number. But as a self-employed contractor, there's nobody remitting income to CRA on your behalf. So that very first year can be a big surprise for a lot of physicians, because they don't realize they're going to have this big tax bill at the end of the year. But when you file your tax return and you haven't paid anything yet, all of a sudden your entire year's worth of taxes are due upfront. So be prepared for that when you start working. Make sure you're setting aside money on a monthly basis so that it's easier for you when the time comes. After the first year, it does become a little bit easier, and that's because of tax installments. So basically, as soon as your your tax payable is over $3,000 in a year, CRA is going to say to you, okay, clearly nobody's remitting taxes on your behalf, so we're going to ask you to do that for us on a quarterly basis. And they're going to tell you, you'll get a reminder every quarter saying you owe a tax installment of X dollars, which will be a quarter of what you paid last year, generally speaking. So that's going to allow you to start prepaying your taxes, so that at the end of the second year, you've already made significant tax payments and you're not going to have this big bill that's going to be a surprise to you.
Awesome. So we did get a question in the chat here. So back to incorporation, and Melissa and Nick, I'll ask you both to address this. How about investing within incorporation account? Is that tax efficient for long-term growth? In addition to that, or using your incorporation to invest into a pension? So Nick, I'll pass it over to you first.
Yeah, I'll start, and I'm sure Melissa will have a lot to add to this, because these are 90% of our conversations. So to take a step back to my earlier comment about the different tax rates and the idea of integration. When you think about getting to a position in your life where your basic needs are met, all your lifestyle cash is met, and you're looking to invest excess cash, there's some options there, right? You have a toolbox full of tools, and you want to make sure you're using all the right ones. So some of the tools are your TFSA, your FHSA, your RSP, and your corporation is just another tool in that toolbox. So first and foremost, you need to make sure that you're using the right tools at the right time. But when we think about the corporation, it can be really good if you've already used up some of those other options. So using $100 of income, just as an easy example, we talked about the average tax rate personally is 50%. So if you earn that $100, you're going to pay $50 in tax. You have $50 left over to invest. Not too bad. If, however, you had earned that income in your corporation, you're going to earn that $100. Your corporation might pay $10 to $12 of tax. And if you don't take that money out, if you invest it within the corporation, that means you have $88 to invest instead of $50. And having that excess capital upfront and every year is going to compound over time and allow your growth to really compound exponentially and get you to a much better spot in retirement. So corporation's a great tool to invest. What I'll say is the tax rates within a corporation on investment income aren't typically as good as the personal rates. So you want to make sure you have the right types of investments, looking at things like long-term capital appreciation, so you're not cycling through selling assets all the time and paying that corporate level of tax. But it can be a really, really helpful long-term tool. And I'll pause there for Melissa if she wants to add anything.
Yeah, thanks, Nick. I really agree with that. And I think the passive income rates, when you start investing in a corporation, it's imperative that you are mindful of the type of investments that you hold because of the clawback on the small business deduction limit. And generally speaking, there's a strategy that you will have for investing within your corporation that will work out with your accountant. But most people, generally speaking, may want to take a little bit more risk with the investments in their corporation and hold their low risk investments in their registered accounts because they're taxed more efficiently. And then I see part two of the question was about investing into a pension plan within the corporation. I do know that we have recently, I think a little over a year ago, launched Medicus Pension Plan, which was brought to physicians by Scotiabank and MD Management. And the number one thing to join Medicus Pension Plan is that you have to be incorporated and you have to be paid by salary. So it's a defined benefit pension plan that should definitely be considered or at least discussed with an advisor like myself to see, does this make sense for you? So there could be a lot of value of having a guaranteed income stream in retirement. And what's really good about this pension plan is it's funded from your corporation versus your personal salary, which again, I could probably talk for 30 minutes about this about this topic, but it's definitely something that you should consider.
Yeah, and I think just to kind of step in there too, a lot of the discussion we've had today is about, we talk about the optimal outcome. We talked about debt, like should you pay it off quicker or should you leave it outstanding so you can earn more? We talked about, pension managing or using a robo-advisor. And I think a lot of these things have a human element to them that are almost as important as the pure financial element. And so things like, having a pension through Medicus that's that defined income stream in retirement, for some people, that's going to be, life-saving to them in terms of their mindset, knowing that it's handled. Other people would prefer to manage their investments on their own, which you can't do within a pension plan. So that might help dictate your decision in conjunction with the actual returns and the actual nature of the plans themselves, is you as an individual and what you like your investment strategy to look like.
Thank you, Nick. I think that wraps it up perfectly. And as noted, it really keeps coming back to this professional team. So one final important message that we want to leave you with is that you don't have to do this alone. As Nick just noted, we talked about a lot of topics today, very high level, and all of these topics I'm sure could be spoken about in length for hours with each of these specialists. So really building up this team around you as you look to transition into practice or establish yourself in your practicing years is one of the best things that you can do. Really getting people who understand the unique challenges that physicians face can help you make informed and confident decisions. So your professional team could include a financial advisor to help you clarify your goals, understand your cash flow, and build a financial plan tailored to you and your career. An accountant to really help you with tax planning and corporation decisions and compensation strategies. An insurance specialist to make sure you and your family are protected and have the right coverage at the right time. A lawyer for reviewing contracts, setting up your corporation, or navigating partnerships, and a banking specialist to support you with tailored lending solutions, credit structures, and practice financing. So each of these professionals will bring something unique to the table. And when they work together, you're better equipped to focus on what really matters most for you, your patients, and your life outside of medicine. So with that, I did want to ask each of our panelists if they have one key takeaway or piece of advice that they'd like to leave the group with today. I'll start with Melissa.
Thanks, Carissa. I think my key takeaway is to really take a meeting with an advisor and have a plan for your goals. Identify your goals. Quite often I'll ask people, when do you want to retire? And they'll giggle and they'll say, oh, I haven't even thought about that. But really just, be aware that you need to plan and identify for goals and to have a handle on your discretionary spending. It doesn't matter if you're making $50,000 a year or $300,000 a year. It all depends on what your plan is for those goals and your excess money.
Thank you, Melissa. Nick?
Yeah, I would say, overall, I think along the lines of building your team, start early and invest in yourself in doing that early. I think, far too often, I see people try to navigate this environment themselves early on. Cash is tight and they don't want to pay a bunch of fees to advisors early on. And they end up spending, or it costs them a lot more in a lot of ways for the things that they didn't know along the way that they then have to fix later. So start early, invest in yourself early, and set yourself up for long-term success.
Wonderful. Sherveen?
One key takeaway that I want to leave you with is know that solutions exist for your project. And just like everyone else mentioned, bringing your team from the beginning, tap into their expertise. And this way you can avoid unnecessary roadblocks and ensure that everybody is on the same page in supporting you with your project and achieving your goals.
Wonderful. And Kish?
Thanks, Carissa. Yeah, I would echo everything everybody said. The most important thing you can do as a physician is take an interest in your finances and your business. We're good at the medicine part, but it's also important to take a personal interest in the business side of what you do. And if you have a really good team that you can trust and work with, you can then concentrate more on providing the medicine to the patients that you want to, while simultaneously growing your financial resources. So grow a team and work.
Wonderful. So if you're not sure where to start, that's what we are here for. So feel free to reach out, ask questions, and start building your team today. If you'd like to connect with us further or learn more or ask questions one-on-one, please feel free to scan the QR code on the screen today. You'll see an option to book a meeting with MD Financial and Scotiabank available there. I'll also ask Nick to drop his email in the chat there as well. He is located here in Ottawa, but can also help to make referrals there. But that does bring us to the end of our discussion here today. I wanted to thank you all again for joining us. Thank you to all of our wonderful panelists as well for this great discussion and all the wonderful insights that you've provided here today. And thank you to CFPC for organizing this session. We really appreciate it.